First, we start with another higher move for the market. Stocks rallying into the close, adding to yesterday's gains, recouping all of Monday's losses. And this week's wild swings got our traders flagging some eye-popping moves. So our traders have come up with the three most ridiculous charts in the market. So we kick it off with the 10-year yield falling as low as 1.13% yesterday morning before rebounding all the way back up to 1.3%. Guy, this was on your radar.
Yeah, and we've been together a long time, Mel, and I think you realize pretty quickly I'm not the brightest bulb in the knife drawer, you know what I'm saying? But one thing I do know is the biggest economy in the history of the world, 10-year yields should be the most liquid security out there. It should not go, in my opinion, from 141 down to 1.25, back to 140, down to 113, up to 130, all in the course of basically 12 trading days. It doesn't make a lot of sense. Bond volatility is extraordinary, whereas equity volatility is not. Something's wrong here. That chart, to me, speaks to potentially some disruptions going forward in the equity market. Bond volatility led equity volatility back in February of 2020. I think we're on the verge of that again, Melissa Lee.
Tim Seymour, how do you put how do you add up 2 and 2 in terms of bond volatility and equity volatility?
Well, first of all, I think Guy is one of the sharper pencils in the light bulb drawer. So, for what it's worth, I think. But I think this observation, I think it is extraordinary. But I think we have seen bond yields for the last 2 years. First of all, as Guy has said, I think bond market will lead the equity market, and I think where the bond market let us lower on yields, well before we were concerned about Delta variants. And on some level, maybe as a function of thinking that the Fed was going to overstep their bounds. The volatility in the bond market, I don't want to see it either. The fact that yields have overshot, possibly on the way up to 175 and possibly on the way down. I think the best thing is really some of the chartists that we've had on the show and the conversation that, look, we got too far too fast, and that on some level you saw that bond prices were way overbought or yields were oversold on the way down. I actually think that was an appropriate move. And as a function of that, I think it sets up our other two charts.
Yeah, it does. And without sort of jumping to them, I still want to touch on this. I mean, unless you think the bond market is not really telling the full story, because the bond market is operating like no other bond market before in history in terms of the Fed's involvement, Steve Grasso. So do you discount these moves, or how do you factor these in?
So I think it's a large portion of this is positioning. So the most telegraphed trade was that inflation was going to tick higher. So people got short treasuries. They got short price, not yield. So if they're short price and they start to have that trade work against them, they have to cover that trade. So when they cover that trade, that kills yield. So while everyone was on one side of the boat thinking that yields were going to spike higher above 2%, that didn't happen. So I don't think it's the macro as much as the positioning trade. So when I look at the chart, we have to get to 1.42 in the 10-year to break out of this declining trend that we've seen for the last 5 months or so. For me, I think that the value trade is going to rip back from here, but I still think that there's going to be a lid put on yields around that 150, 160 mark.
All right, let's get to the next ridiculous chart, because it does sort of all dovetail together. And Karen, you flagged this one. This is the OIH oil ETF, up 11% from yesterday's low. What do you see in this chart?
Well, I just see, I don't know if it's like lemmings running all at one time. Maybe it's the Merrill Lynch herd, the bullish herd. I don't know. But it seems, how can all this valuation just magically change just like that? I know why the sentiment is, because, all right, maybe we've sort of overly concerned about the Delta variant and it's not going to be that big of a deal. That might be part of it. There was some good economic data. That might be part of it. I'm not really sure. But so that chart's kind of crazy to me. Obviously, we had a giant oil move and we had the OPEC move in there, which Tim talked about yesterday. But back up a little more. I think we have another chart that goes what may be considered ancient history in a market like this, but back to June of 2021. And we see the OIH at 240. So the move from 240 to 177 is so gigantic. That's just ridiculous to me. So that seemed very, very oversold. So I have some OIH now. I had it last week. I had a tight stop. It got immediately lost money out. I'm in now. I think I don't think one has missed the move back up when you step back to that June chart and take a look. That is just an enormous move. Maybe we never should have been at 240, but we certainly shouldn't have been at 177 either.
Guy, two charts don't make a trend, and we still have a third ridiculous chart, which we shall get to in a mere moment.
Can't wait.
But so far, what these two charts tell me is that the markets move in extremes. They move in integers, not decimals, when it comes to a short amount of time in the ground that they can cover. So what do you make of this oil move in that context? Because it's almost not surprising.
So I'm about to get myself in a lot of trouble with you. So typically, if we goodbye the guest, we don't bring him or her back.
Are you
but
going
I want
back
to bring
to the first
back
chart?
quickly. Yes, quickly, if I may. But since I'm not here, you can't hit me. I basically can do what I want. You know, Steve made a great point. I mean, positioning was crazy. He mentioned boats. My pushback, and I'm not looking to necessarily have a conversation. You know, we're not talking about the SS Minnow here. We're talking about the Queen Mary. That boat shouldn't move as quickly as it has. That's just my point about bonds. In terms of the OIH, I'm with Karen. Same type of thing. It shouldn't move that way. But if you're looking to play it, I don't think it's over. I think Tim would probably agree. I think the energy trade paused and it was painful. But Halliburton, for example, traded down to 19 and change, same low as we made back in April. I think you have really tradable levels here in the OIH and individual stocks. Halliburton sticks out to me, Mel. I'm sorry. Don't get mad at me, please. I'm begging you.
Never can I remain. I was mad at you for a split second, but that's past. Grasso, though, if I read these two charts as a story, then, though, it would tell me that investors believe that the recovery is on. Is that a storyline you can buy into?
Yes, and I can buy into that because we're going to see a boom in the economy once it does really kick up and once we leave the Delta variant headlines behind us, or at least maybe they're not that impactful. But when Guy brought back the guest with the 10-year yield, if you overlay those charts, they look very similar, if not identical, the OIH and the 10-year yield path. That means to me that positioning told you which way the yields were going, and now the rest of the market is buying it based on yield or selling it, to Karen's point, from 248 down to 177. I think if you're a trader, and there's a lot of people out there watching, I think you can bounce back in the OIH probably to the 212 area, which is in between the 50-day moving average and the 100-day moving average, almost smack in the middle if you're a trader.
All right, well, let's get to our final ridiculous chart of this evening. And that would be the giant move in U.S. steel. And perhaps this also mirrors the prior two charts. No, I'm not bringing back the guest, so to speak. The stock is up 5% this week alone. Tim, you flagged this one.
Zany, cuckoo. I mean, what else can we say? You know, but not so much when you consider that. First of all, steel prices have actually held a lot of the gains that they've had from pre-COVID, which are about 2.5 times for hot rolled coil. I chose steel because, first of all, it is a higher beta, and U.S. Steel certainly to other, call them. It's not even a resource play. It's an industrial play. And a close second zany chart for me might have been the XLI or the industrials. But let me take steel. That 13% move off those intraday lows on Monday are more, illustrative of where I just think, whether it is auto production, whether it is steel, whether it is home builders, these are sectors that I think are going to continue to be booming in the second half. So a lot of this really was everything trading together. And I think the fact that you've actually seen this recovery. Look, let's be clear also, as much as we talked about how the S&P and certainly the NASDAQ 100 were largely saved by FANG names over the previous 5-6 weeks, the S&P is up 3% from around 2:30 p.m. on Monday, late in the day of trading, to where we closed today. So I think a lot of this cyclicality, industrials, transports, resources have actually carried the market, and I think they will continue to carry it, which is what I hear everybody saying, at least in the short term.
Yeah, Guy put together these charts: the snapback move in yields, snap higher in OIH, snap higher in U.S. Steel. The
growth scare is probably overdone. The I guess the reopening trade is alive and well, and in terms of resources, they're not going away. And I think Tim would agree with this as well. You go back to March of 2018, U.S. Steel was a $45 stock on its way to 60 before the administration came out with the tariffs. And we can argue whether or not that was the right thing or wrong thing. That's just fact. The stock went from 45 to 9 over the course of about 2 years or so. I would submit the steel industry's probably never been better situated, and U.S. Steel's probably never been run better. And here we are at 24 bucks. I mean, I'm not saying it's going back to 45, but into earnings on July 29th, there's no reason why this shouldn't have a 3 handle in front of it.
So actually, based on what you all are telling me tonight, maybe these aren't the most ridiculous charts in the market. They might be ridiculous moves, Karen, but the narrative that these charts tell is one that the recovery is intact.
Right. Well, so maybe we're ridiculous and the charts are not, right? That could be the case as well.
Story.
But yes, that is
ridiculous.
Right. Yes, we know it. But I think that the recovery story is still intact. I've thought it was intact. I think we still have a huge back to school season. I think we still have a rebuilding of inventory, right? So that's going to be partial boom. And the other thing about where we are in the recovery, I think given all the supply chain disruptions, companies don't want to get back to the inventory levels they had before. They want to get back to more inventory and more cushion, I think. So I feel like that's going to be a tailwind for industrials for a while, for manufacturing as well, for a while.
Shepard Smith here. Thanks for watching CNBC on YouTube.